Let's finish up our valuation discussion by talking about the corporate valuation model and then briefly a couple of other models. So the corporate valuation model is also sometimes called the free cash flow method because what we're doing is we're discounting the firm's free cash flow. So oftentimes we might want to consider this approach if the company doesn't pay dividends. So recall the formula for free cash flow, and so that's shown below on this slide. So in order to apply the corporate valuation model, we're going to need to find the market value of the firm by finding the present value of the firm's future cash flows. And then from that market value, we're going to subtract off debt and preferred stock to get the market value of the common stock. Once we have that, we can just divide it by the number of shares outstanding to get the intrinsic stock price, or the market value of one share of stock. So some reasons why people like it or don't like it. They like it better than the discounted dividend model sometimes because, as I mentioned earlier, it works for firms that don't pay dividends. And so it assumes that at some point the growth in free cash flow, just like the growth in dividends in the dividend model, will grow at a constant rate. And just like in the dividend model, you're going to need to calculate a horizon value once you get to that constant rate. So here's an example. We have a long-run free cash flow growth rate of 6% and a weighted average cost of capital of 10%. We haven't covered that concept yet, but that's what we're going to use for our discount rate. And so now we can figure out what the free cash flows will be and figure out a horizon value. Again, in this example, we're calculating that horizon value in year 3, and now that we've got all the future cash flows, we can discount those cash flows and sum them up, and now we have the current market value of the firm at $416.94. So now what's the intrinsic value per share? Well, if they've got $40 million in debt and preferred stock, and 10 million shares of common stock, I'm going to subtract off that $40 million from the market value that we found, and that gives me $376.94. If I divide that by 10 million, because that market value is in millions also, now I have a share price of $37.69 as my intrinsic value using the corporate valuation model. Another approach is to use multiples. So we've talked about the price to earnings ratio before. That's a popular multiple that you could use to value stocks. Price to cash flow is also a possibility, as well as price to sales. And so what you do is you find a comparable firm and estimate that firm's PE. And so you just multiply this by the expected earnings and back into the stock price. Economic value added is equal to the equity capital times return on equity minus the cost of equity. So the market value of equity then is equal to the book value of equity plus the present value of all the future economic value that's added to the firm. And then value per share is the same as before with the corporate valuation model. Now lastly, we just need to touch on preferred stock again, and remember it's a hybrid security, so it's somewhere in between stocks and bonds, because like bonds you get a fixed payment even though it's called a dividend, but like stock you do have some ownership in the firm, and so companies can choose not to pay. I guess this is the biggest difference, is that companies can choose not to pay that dividend, and they can't be pushed into bankruptcy like the way that bondholders can push a firm into bankruptcy if they don't make the coupon payments. So with preferred stock, just an easy example, the value of preferred is just like we talked about before, where growth rate is equal to 0. So it's a dividend payment divided by the cost of preferred. So if we have an annual dividend of $5 on a preferred stock that's selling for $50, then the cost of preferred is 10%.